Tax efficiency can be a powerful element allowing individuals to maximize savings in their retirement years. Melanie Dunn from Accurium has joined me today to examine how this concept can be advantageous. Hi, Melanie. Welcome.
Hi,
Great to
Darren.
see you.
Lovely to be here. Thanks for having me.
Individuals often establish a pension for their income needs in retirement, and this will allow them to take advantage of exempt current pension income rules, or ECPI. So, how does ECPI work?
Yeah, well, you're right. It all starts with starting a retirement phase income stream in a self-managed super fund. So an account-based pension or a transition to retirement income stream in retirement phase. One of the benefits of starting these pensions is not just starting to have access to your superannuation for your retirement income needs, but by starting a pension that is a retirement phase income stream, the earnings on assets supporting those pension liabilities can be tax-free. And that's where ECPI, exempt current pension income, comes in. It's really valuable for SMSFs that have members in the retirement phase and effectively allows them, the trustee, to claim some or all of the fund's earnings as exempt from income tax in the SMSF annual return. And it's a big deal. 43% of all self-managed super funds, if we look at the 21-22 tax return data, claimed ECPI to a total of around $19 billion. So, it's a really valuable feature available for SMSFs in the retirement phase. It can get a bit complicated for how to work out ECPI because there are a couple of methods you can use to claim ECPI. There's the proportionate method and the segregated method. So the proportionate method effectively is where your self-managed super fund has both accumulation phase or non-retirement phase interests in the fund and also has retirement phase interests. If you've got that mix of both retirement phase and non-retirement phase over an income year, then that fund would claim ECPI using the proportionate method. What you do is you get an actuarial certificate from an actuary who will certify to the trustees what proportion of the fund's income you can claim as exempt current pension income in the annual return. The other method is the segregated method. It's perhaps not quite as common. Where it does really come into play is where a fund ends up solely in retirement phase. So if you think about the stages that an SMSF might go through, we have members in accumulation phase, they're working, contributing. Maybe one of the members retires, but one of the other members is still contributing. That's where you might get that mix of a member in retirement phase and another member in accumulation, where you use the proportionate method. But then once that second member perhaps decides to retire, and assuming they can move all their balance up into a retirement phase income stream, and that fund is solely in the retirement phase, that fund could use the segregated method to claim ECPI and claim all of the relevant assessable income as ECPI and tax-free. And you don't need an actuarial certificate if your fund is solely using that segregated method. It can get a bit more complex than that, Darren, but that's the basics.
I can see why it's so popular with the stats that you just provided us with. Apart from choosing the calculation method, is there anything else trustees need to do specifically to claim ECPI? And can you change which method you use from year to year?
Yeah, good question. So there are a few things you need to do to be eligible to claim ECPI. If you're using that proportionate method I mentioned, which around 60% of funds who are claiming ECPI might do, you need an actuarial certificate, as I mentioned, if you want to claim ECPI. You actually don't have to claim ECPI. There might be scenarios where you don't need to. Maybe your fund's in a loss position and you don't have any taxable income to claim ECPI on. But in general, if you want to claim ECPI under the proportionate method, you need an actuarial certificate, and that's each and every financial year that you want to claim ECPI. Some other things to think about is there's this idea of the choice, or how you decide what method you need to use to claim ECPI. One key concept to be aware of there is disregarded small fund assets. A bit of a mouthful, but basically if your fund has disregarded small fund assets, you have to use the proportionate method for tax purposes to claim ECPI. So that's really important to be aware of. And these rules came in back at 1 July 17. Effectively, if you have a member at the prior 30th of June who has a total super balance at or above $1.6 million and has a retirement phase interest, they can cause that whole SMSF to have disregarded small fund assets, and you have to use the proportionate method. The other reason to think about how you claim ECPI or what can restrict what you do, as I mentioned, if you're fully in retirement phase, that's kind of easy. You can use the segregated method. What we can see is scenarios where funds have kind of both scenarios in one financial year. They might have a period of the year where they have a mix of accumulation and retirement phase, say that's for half the year, and then that pension, that member moves into pension phase and we're solely in retirement. So what does the trustee do there? Well, they actually have ECPI choice. Now you have this choice if your fund doesn't have disregarded small fund assets. And the choice is effectively something you can make at the end of the year to decide, well, will I use both methods to claim ECPI? Will I use the proportionate method for the year to get my actuarial certificate? And that actuarial exempt income proportion will apply to the part of the year where there was that mix of accumulation and retirement phase, but also use the segregated method for the half of the year where the fund was solely in retirement phase. Now, the fund could choose to do that. That's kind of the default position. Or they could choose to use the proportionate method over the whole year. You see, it's getting a bit more complicated for these types of funds. Well, which one should I use? You might have to work out the outcome under both methods to identify what's in the best interest of your client. So yeah, it can get really, it can get complicated with these multiple periods of segregation in the year and unsegregated. And we've got, lots of strategic things to think about there as to what's the appropriate ECPI outcome for the client. If you do have any questions, please contact your actuary. They've got lots of information who would be able to help you. I think that's it, Darren. The other thing, as I said, you don't have to claim ECPI. So if you don't want to claim ECPI under the proportionate method, just don't get your actuarial certificate. You will have no ECPI claim, and yet you can not claim ECPI under that proportionate method if you don't want to.
Mel, you just mentioned disregarded small fund assets as being one factor that may restrict you from claiming ECPI, but are there any others that trustees need to be aware of?
Yes, the main one is making sure your retirement phase income streams are eligible to claim ECPI. That is those pensions, the retirement phase tris or your account-based pension generally has met the minimum pension standards. So we know that when you have one of these income streams, there is a requirement to take a minimum pension payment and cash that payment to the member each financial year. If you don't do that, that pension may not be eligible for ECPI. So that's a really important one to make sure each of the pensions in your self-managed super fund do meet the pension standards and make that minimum pension payment each year. Some other ones to be aware of, well, I think if you're not in retirement phase, then obviously the restriction is you're not eligible to claim ECPI. You have to have an interest in the fund that's in retirement phase to be eligible to claim ECPI. And the other case to be aware of would be if your fund has legacy defined benefit pensions. Now, there's not that many of these around, but if you come across a self-managed super fund with one of these defined benefit pensions, you need a special type of actuarial certificate for this fund, as you need a special actuarial valuation for that defined benefit income stream. So that's just kind of a tip to be aware of. If you come across one of those more complicated structures, contact your actuary, as you'll need a different type of valuation certificate, which will also have your exempt current pension income calculation in there as well.
Okay, great. Well, thanks for the discussion, Mel. That was really informative. Melanie will be covering this subject and more at the SMSF Professionals Day 2025, co-hosted by Self-Managed Super and Accurium. It's a 3-city roadshow with the event kicking off in Sydney on the 22nd of May and concluding in Brisbane on the 29th of May. There will also be an online component. To find out more about the event and register, please reference the details you can see on your screen now. Thanks again for your time today, Melanie, and I look forward to your roadshow presentation.
See you all soon.